Morning, everyone. Thank you for taking your time out of your busy schedules to listen to a few of us at Brand share our thoughts. Our hope is that we will give you both some confidence in your investment approach, as well as a guide to a more fruitful conversation with friends and family. We are certainly mindful to the limits 1 hour can put to such a conversation, especially considering the good questions that we received. Therefore, we'd like to go ahead and get started after a brief introduction to the other speakers and myself. Ryan Green is the first advisor I will introduce, and most of you know him well already, given his long tenure at the firm. He is on his 14th year with brand AMG, most of which he has spent as an advisor. Ryan is married to Sarah and is the father of 2 young children. You will understand why his mind is the most respected in our firm during his discussion on investment discipline, taxes, and estate. Next is Tim Egart. He is enjoying his 6th year as an advisor at Brand, and Tim's a real true team leader. Tim is married to Allie and the father of 3 young boys. His intellect is matched by an equally powerful passion to serve. I'm more than confident that his thoughts on inflation, bond strategy, and the current political and social environment will provide meaningful value. Lastly, I am James Blake, the newest advisor on your Brand AMG team. My tenure here started about 1.5 years ago. I am married to Becky and the father of 3 young children. I get the privilege of working alongside and learning every day from these 2 other gentlemen, along with an excellent team full of leaders and experts. I will begin the rest of our conversation with a transition to our current market outlook, and then address the first question regarding market valuation.
What an intro.
And now we have to live up to it.
Yeah.
I'd like to start the market outlook with a quote from an economist, Howard Marks. Investors often imagine 2 distinct macro environments, times when the future is clear and times when it isn't. In reality, though, these periods are all pretty much the same, since perceived clarity regarding the future often turns out to have been illusory. Isn't this so true? If it's actually possible to look back at the outlook on the economy back in January of 2020, most experts felt confident in the economy and that the bull market would continue to advance. At the very least, there were no major obstacles identified to make it stop. Essentially, it was a period of perceived clarity. And we all know what happened. Contrast that to time now. Isn't really the opposite true? Both strong bullish and bearish arguments can be given. Forecasts are more remarkable for their highly divergent opinions regarding market valuations, potential market sell-offs, and especially worries of inflation. We will lay out our thoughts on potential positives and negatives after we look at current asset class performance. So you'll see we've had very strong market returns in equities. We have continued to struggle with our bond returns, which we will discuss in detail further. And a lot of these asset classes are ones that were hit very, very hard last year and have seen a dramatic recovery. Some of the positives and potential negatives that we'll see, at least for the short term, are vaccinations. With the CDC estimates of over 70% of the US individuals who have either been vaccinated or infected with COVID and recovered, a progression toward a more normal life is currently occurring. Hopefully, all of you have seen examples of friends and family who have gained more confidence to return to normalcy after receiving a vaccine. The stimulus multiplier. As restrictions are being relaxed or eliminated, the fiscal stimulus to our local economies will have a greater effect. In other words, as we see more of the economy opening, the stimulus should have a larger multiplier. With jobs, the March employment data and payrolls increased 916,000 for the month, against an expectation of 660,000. Importantly, leisure and hospitality saw the greatest benefit, up 280,000 respectively. We expect gains in jobs in the months ahead to continue if renewed shutdowns do not occur. Housing continues to be a boom. Prices have soared in the past year, as many of you have likely noticed. And this begs the question, should we expect a bubble? A lack of homes, a deep dive into the data suggests that this price increase is based more on fundamentals than in the early 2000s. Lack of homes appears to be the primary issue driving prices. For instance, housing starts have lagged behind expectations for the past 20 years. So we're not keeping up with population growth and scrappage from natural disasters. Combine the factor of people that are now moving away from locations like New York and San Francisco, where renting is popular, to places where home ownership is more popular, and home prices may continue to rise. The next item, stocks are still cheap. This bullet point really needs to be qualified, and we will address valuations in our first common client question, but it may be better put that some stocks are still cheap. Excess savings, approximately 1 trillion in excess savings, combined with the pent-up demand, may lead to a boost in consumer spending, especially in the service industry. And then monetary stimulus. The Fed continues to show us that it has diverse weapons to use in an effort to keep the economy recovery going. There's always potential negatives. A slower vaccination rate and or a COVID strain mutation could delay a full recovery. And then the potential for inflation. As all of you might imagine, questions regarding inflation and the possibility for rising interest rates were a common theme we received regarding this webinar. We believe this to be the biggest risk we currently face, and we'll address it accordingly later in our discussion. And then political disruption, whether from within or abroad, there is always a potential risk for political disruption. This is also a topic we'll discuss at length. But rather than a lecture just going over bullet points on a slide presentation, the spirit of this webinar is really to address some of your more common client questions. The first of which is, don't you think the market is too high to invest in now? This is a great question, and one in particular that has divergent answers from experts. So stated differently, is the stock market undervalued or overvalued? From our perspective, the answer is yes. On one side, there is the argument that the price to earnings PE ratio is high by historical standards. Quantitatively, this is true. As of last week, the PE ratio for the S&P 500 was 32.6, compared to historical levels of 15 to 16. In March of 2000, for more perspective, the height of the tech bubble, that number was 24. Additionally, total market capitalization of the S&P 500 has reached about 204%. But on the other hand, experts have shared a qualitative dive into the S&P 500. Because this index is market cap weighted, certain technology stocks have had an outsized impact. For instance, what if we separated the top 10 market capitalized stocks from the rest of the index? At least some of that top 10 of which are overvalued. And then we created the S&P 10 and the S&P 490. What you may find is that the valuations on each diverged dramatically. Please let me add a little more color to the topic. The top 10 holdings in the index represent 26% of its value. If some or all of those stocks look overvalued, then the overall market takes on appearance of too high to invest. The Fed is holding interest rates persistently low, and low interest rates make higher PE ratios more sustainable. And the GDP was artificially low last year due to lockdowns and restrictions. Real GDP is expected to grow in 2021 at 6+%, with S&P 500 earnings expected to grow by 27% or more. And historical average GDP growth rate is around 2.5%. All of this is to say that we feel valuations are distorted and that certain stocks are expensive, but the market as a whole remains undervalued or fair? A similar question we received will be addressed by Ryan Green.
And thanks, James. I might just add to that too, that remember, oftentimes people fall into this idea that, okay, if I've got money to invest, but the market's at all-time highs, maybe I should wait to invest that money. And James did a great job talking through some of the rationale for why, at least right now, there's nothing that really seems like, well, we're ready for the bottom to fall out. Remember too, that when you're contemplating investing into a portfolio, it's not just going into the market. Right? Those of you that have worked with us over the years know how big proponents we are of diversification and having dollars allocated all over the world, all different types of segments. And remember that just because the market may be at all-time highs here in the United States, that doesn't mean that all markets in the United States are. It doesn't mean that all markets internationally are. And it certainly doesn't mean that for those dollars to get allocated to other asset classes like your alternatives or your real estate or your fixed income, you don't put every dollar into the market. So it's just a little bit of additional color there. But thank you, James. Thanks for the warm introduction. And just I'll echo the comments that you shared at the beginning. I wanted to thank everyone for joining today, taking the time to hear some thoughts on the subject. Thanks to each of you that provided your questions in advance of this. We're going to do our level best to try to answer each of those as best we can in a relatively short amount of time. One of those questions, as Jay mentioned, that's somewhat related to what he just talked about is the persistent question. What's the market going to do this year? What's the forecast? What do you see? What should we be prepared for? Not only is that a question that we got in advance of this event, it's also the question that I get almost every single time I meet someone new and they ask me what I do. I tell them and they say, oh, what do you see in the market? What's the market going to do this year? And somewhat tongue-in-cheek, somewhat little bit more glib maybe than I should be, a little more flippant than I should be. I tend to answer with, I don't know. I do this for a living. I'm around this all day, every day, and I don't know what the market's going to do tomorrow, let alone for the rest of the year. And I think that really speaks to the underlying theme. And the best way that I can try to answer that question is we don't know, you don't know, nobody knows. Anybody that tells you that they know usually has a sales agenda, in my experience. And so I'll share a little bit of data here on the market from last year. If you'll give me just a second. So you should see here a little bit of a recap of what we saw in 2020. Now, those of you that watched our Market Outlook webinar and review from January, this slide should look very familiar because I stole it directly from that presentation. And I stole it because I think it's good and it speaks to something very valuable. And that is, going into 2020, as James mentioned, no one saw 2020 coming. Nobody expected the events that played out in 2020 to play out. And what that really resulted in, as far as the market was experienced, was a very, very extreme market sell-off from hitting all-time highs February 19th of last year to the lows on March 23rd of last year. You can see here arrayed across the screen are the different investment categories that James just talked about earlier. But the sell-off ranged from anywhere down 33.8% for the S&P 500 to down 43.4% for global real estate. It even touched the bond market, as you can see several negative returns for some of the categories within the bond markets. And anybody that attempted to try to predict what was going to happen in 2020 would have obviously very, very, very strongly missed this. And if you ask the same collection of experts in the industry on March 23rd what they expected for the rest of the year, I highly doubt any of them would have predicted this, myself included. The market's recovery from the lows that we saw in March was extremely strong. Now, I share this data to really illustrate a point, and that is when you try to predict the future, when you try to divine what the markets are going to do, more often than not, you're going to end up looking silly. The Wall Street consensus expected return for the market last year, 2020, was 2.7%. Now, the 2.7% is probably a little bit misleading. There were probably predictions that ranged from up 30% to down 50% and everything in between, and where you wound up was up 2.7. Well, of course, that was wrong, and the whole story was wrong. So trying to reliably predict the market, again, a very difficult thing to do. And in fact, I find this absolutely hilarious. So Bloomberg, very well-respected media site, a lot of resource, a lot of smart people working there, a lot of great information, a lot of great articles that they publish. But on January 1st of 2020, they published an article titled, "What to Expect from Markets in 2020." Okay, that's fairly typical. This is funny. On December 29th of 2020, so after the end of the year, they published another article, and it was called "Ignore All Market 2021 Predictions." I mean, the same organization with, here's what we see in 2022, don't even bother trying to figure out 2021, is pretty amazing. And that really does reinforce that idea of trying to be predictive, again, very, very difficult. You may remember, too, there was a presidential election mixed in last year. Not only was it a presidential election, it was a pretty hotly contested election that wound up concluding with the storming of Capitol Hill. I mean, crazy things. A lot of people, a lot of investors leading up to the election were very concerned about what the election results were going to mean for the market. And that's on both sides of the political spectrum. You know, if my guy wins, it's going to be horrible or great, or if my guy loses, it's going to be horrible or great. And again, everything in between. So what did the market end up doing? Well, it did what it usually likes to do and helped us all feel a little bit more foolish and a little bit more humble, because the market actually finished 2020 incredibly strong. So that if more than any other year, as long as I've been doing this, 2020 shared one thing, it was that trying to reliably predict the market is very, very difficult to do. Now, I say that, I'm speaking about short-term market movements, you know, day, week, month, year kind of thing. But this slide here really backs out a little bit. And for those of you that watch our events, you've seen this one before too. I stole this one also because it's good stuff. It's good foundational information. And this really gives you an overview of the S&P 500 going all the way back to 1970 and all the ups and downs along the way. Some of them a little bit more modest, a little less scary. Some of them deeper, longer, definitely scarier. You know, you can look at the tech bubble and the financial crisis from 2007, that started late 2007, excuse me. But the idea here is that over the decades kind of a viewpoint here, you can see that the S&P, the market has made you money. It's been a little bit of a bumpy ride at times, but it has made you money over the long run. And it's important to keep that longer term perspective when you're thinking about the question, what's the market going to do this year? Should I change my investment strategy based on something that we see that might happen? I don't think you can reliably do that. And I think over the long run, you will end up hurting yourself more often than helping yourself, because the market does make you money over the long term. You just have to stay engaged. Here's another stolen slide from you guys. For those of you who've been around for a long time, you might have seen this one as well. But we'll often get the related question, is the market going to have a correction this year? Or are we going to see a bear market this year? And usually when people ask me at least about the correction, I say, yeah, probably. Because on average, the S&P does have a correction each year. On average, the S&P from its peak to its trough is somewhere around 14%. So on average, you should expect to see a correction each year. And in my experience, when there's something scary, but it's expected, it's a lot easier to deal with, live with, and plan around than something that's completely unexpected. The key here is how you react. It's how you view these periods of market volatility. It's what you can do in those seasons that can really help determine your success or lack thereof as an investor. And the last slide I'll share you on this particular topic is yet another stolen slide. I stole all of them for this portion of the conversation today. This is a study done by Dalbar that we love this slide. They update this every year. It's at least I don't have the updated one for 20, but it stays the same every single year. And what you can see here are different returns for various categories over that 20-year time frame on an annualized basis. But I'll call attention to the two blue bars you see right here. One is the return on average for just a 60-40 portfolio, 60% S&P 500, 40% in a bond. This would be a 40-60, 40% S&P 500, 60% in bonds. And you can see the returns there were in the mid fives. Not a whole lot of brain power goes into a structure like that. You kind of set it and forget it. But the average investor over that same time frame got a return of 2.5%, significantly less than the market should have afforded that investor. And the reason why that happens is we as humans tend to be highly emotional, especially with our money. And our natural predisposition is to make decisions and do things that are at the wrong thing at the wrong time. You know, when the market's scary and selling off, that's when people want to run away. When the market's hitting at all-time highs, that's when people want to invest more into the market. We think you should do the opposite. And I would say that is the predominant theme as I try to answer this question is we don't know what markets are going to do, but we know exactly what we're going to do once it does it. If the market sells off like we saw last year, if we see that, I'll go back to that slide, that 33.8% sell-off in the S&P 500, our clients were buying stock after that pullback, not selling stock after that pullback. As things began to recover and the S&P 500 was up 70% for the rest of the year, our clients were selling the S&P 500, which, if you think about it, the volatility, and 2020 was a great lesson in this, the volatility, those periods of volatility can actually help you as an investor. As much as you may not like it, if you could consistently be a buyer of stocks at reduced prices and a consistent seller of stocks at higher prices, that is a pretty good way to make money over the long run. So hopefully I've answered that question. It really is, I don't know, but we do have a plan, and we really do have a good structure to help clients navigate market volatility. Whatever it throws at us, we can help solve. So with that, now we'll go ahead and turn to the next question.
That's great, Ryan. The next question that we received was, are we prepared to invest in a world of higher inflation? And I'll back up a second just to highlight the fact around our inability to predict the markets. I would argue is even harder to do. It's harder to predict the direction inflation is going to go. We can look back 15 years since the great financial crisis, and we can talk to Ben Bernanke, we can talk to Janet Yellen, and we can talk to Jerry Powell and ask, where's inflation? Because since that time, they've been trying to create inflation, and we haven't really seen it. I'll share a chart here that highlights what we've seen historically with inflation. And so obviously, in the 50s, whatnot, modest inflation at 2.5 or so, and Volcker trying to fight back inflation and rising interest rates significantly during the season of the 70s and 80s. But really, since the financial crisis, we've seen 2.2, 1.8, and recently in March 21, a 1.7 figure for inflation. The Fed's trajectory, their target is 2% inflation for context. We have seen a recent uptick in inflation. It's hard to argue against. The Fed's comments around this are, it's more transitory. That's the word that they're largely using. It's transitory. And their reasoning for this seems to make some sense. There's supply chain disruptions that have occurred across the globe, right? As the world has faced the pandemic, our globe is an interconnected environment where one company is getting goods from all across the world for their product that they ultimately sell to consumers. As those disruptions have occurred, it has affected the supply chain and actually supply. As demand has increased, it has driven up some costs for ultimately those end products. Their view is, as some of those supply chain disruptions get resolved, inflation might taper back down to a more normalized level. That might bear itself to be true. If they're wrong, right, we just talked about the experts over the long haul trying to predict the future. We don't know entirely where things will head. So if we saw a higher level of inflation, to answer the very good question, are we prepared to invest in a world of higher inflation? The answer is, what is one of the best assets to own in periods of higher inflation? And that would be stocks. That is one of the best ways to hedge against inflation. And I'll use an example of this. So we think about Apple, who is a global provider of products and services. Apple has its flagship offering is the iPhone, and you can buy an iPhone for $800 or $1,000, and they get inputs to create that iPhone from across the globe, from batteries to little glassware to ultimately the input costs for their employees to create those. And as those input costs rise, as the cost to create that iPhone rises due to levels of inflation, they have two options that they can do. They can, one, eat those costs and continue to sell the iPhone for $800 or $100, and that will ultimately affect their margins. Or two, they can pass those prices on to consumers, which largely they do. As they pass those prices on to consumers, who then go out and buy, as opposed to an $800 iPhone or a $1,000 iPhone, they spend $850 or $1,050. And what happens to their stock price? Well, it will rise because their earnings continue to grow because of the increased costs that they're paying, that they're selling their products for. It doesn't always happen in lockstep like that, but through time, generally speaking, stocks are a wonderful hedge against inflation. That's one side of the equation, which leads to our next. So I've highlighted here, actually, before I go into the next question, I will just highlight briefly. Here is where the world kind of sits and looks at a 5-year expectation of inflation. So again, this is just a forecast at a moment in time. But as of 2/24, the world looked out and said, what does inflation look like 5 years from now? And generally speaking, the target is right around a 2 handle. The Fed's trying to get to 2, and they're okay. They've even evidenced they're okay running a little bit higher than 2 so that their long run trajectory points towards that. This is a 5-year expectation. So generally speaking, the world doesn't see runaway hyperinflation or anything like that in the United States, hovering around 2 at least short term. But again, peeling back to the question that I was about to ask is, so stocks are a good hedge against inflation, but what about the bond side of the equation, which was the next question? What is your bond strategy if we're anticipating inflation? And I'll back up a quick second to just remind everyone, one of the reasons we own bonds is predominantly for volatility control, to mute the risk in a portfolio. And this is a chart that helps to highlight the value of bonds when we see a declining equity market. So this highlights a few different scenarios from 1926 all the way to the first quarter of 2020. The green on that screen highlights investment grade bonds, while the blue evidences the S&P 500. And what we're seeing is very simply, as the S&P 500 falls, bonds help to generate a return. They're muting the volatility in the portfolio. And so it's important to remember the purpose of our fixed income component or our volatility is predominantly for volatility control and muting the risk over a long period of time. With that said, if we are in a period where fixed income rates have fallen since 1981, so in 1981, as Chairman Volcker was fighting inflation, he allowed interest rates to rise materially to fight back inflation. Since that period of time, we've been on a 40-year run of falling interest rates, which has helped fixed income returns over that period of time. Now, if we are in a season where there is a rising interest rate environment, which we've alluded to, generally speaking, it seems we're there. It seems we're heading that direction. But I would argue we've also felt that for the last 5 to 10 years. And so where we're at today, if we do see a rise in interest rates because of the Fed and our federal and monetary policy, the question is, how do we respond to that? And so one of the things that investors can do, this is a highlight of investment grade bonds and their duration. So as yields have fallen, as the yield we can get on our fixed income investment has fallen, duration has risen. There's 2 components to why that's occurring. One, duration is just an effect of maturity of a bond and the coupon you're receiving, the amount of yield you're receiving. As yields have fallen, it's naturally extended duration, but there's another effect to this too. Duration has been extended for investors that have tried to capture a little bit more yield to generate a higher return. If we extend duration, there is risk involved in that. And you'll see this actually very simply stated on this chart. Higher duration fixed income portfolios have more sensitivity to interest rate risk. Lower duration fixed income has less sensitivity to interest rate risks. If I'm buying a 30-year bond and I'm locking that in at 2.5, that's effectively guaranteeing a 2.5% interest rate. If yields rose to 3 or 3.5, I would lose money on my fixed income component. So what we have been doing is continuing to manage the duration and keep that short to intermediate term overall. So we're continuing to look at and evaluate duration and bring that down, relatively speaking, for the long haul, recognizing that what we think today might change in 6 months, might change in a year as more and more data components come to the fore. So we've answered a couple different questions in terms of how do we manage inflation? That's stock investment, right? That is a good hedge against inflation if we see it more pronounced than what the Fed is anticipating. And two, in a rising inflation environment or in an inflationary environment, how do we control for the effect that rising interest rates, if that occurred, might have on the bond component? And that's evaluating shorter or intermediate term duration alongside diversifying that across the spectrum of fixed income investments from high yield to emerging markets, non-traditional, and short and intermediate term. But really controlling for the duration risk in a portfolio is one of the most important things that we can do to manage a rising interest rate environment if we saw that more pronounced than we see today.
Well, too, remember, it's not just fixed income. That's not the only tool we use to try to help mitigate volatility in portfolios. We also do use a category of investments that we call other alternatives that really are designed to try to provide some of that volatility control, some of that downside protection without facing some of the challenges that we've seen in the fixed income markets. And in fact, so far this year, as fixed income returns have been not good, the other alternatives have been able to provide a little bit of a better return in that space.
It's a fantastic addition, Ryan. Fantastic comment. Could not agree more. And with that, you want to talk everybody's favorite topic, taxes.
Sure. So that is a pretty notable question right now. We're really framed as simply as, are taxes going up? How high will taxes go? You know, will the market continue to perform well with the threat of rising taxes? And it's another one that's pretty challenging to try to predict. So we can give you a little bit of an overview of what we're seeing right now. And this kind of starts back on the campaign trail for Joe Biden. He wasn't at all shy about being very vocal about increasing taxes, focused primarily on the affluent or the rich with higher incomes. And in fact, just very recently, he made an announcement of about a push to try to increase the capital gains rate, which there is a little bit more of the story there, I think, than maybe just the headline would lead you to believe. So just at its basic level, what we're talking about right now would be a reconciliation bill, which is important because a reconciliation bill, which is typically limited to budgetary type things like that, is a way to get a new tax package or a change to the tax code put into law. And it's important because that would require only 50 senatorial votes as opposed to 60. And with a divided Senate, that means the path to actually getting that passed is a little bit easier to try to get done. So as we sit here today, this country has a roughly $28 trillion national deficit. And Joe Biden also wants to try to get a bill passed that would actually potentially be tied to the same reconciliation bill. Try to get an infrastructure bill put through that would result in another $2 trillion and some odd dollars worth of spending, which of course the question is, well, how do you pay for that? Higher taxes always seems to be the answer. You know, curtailing spending elsewhere across the government typically not been very successful or rarely happens. So this would be an enhancement to the tax code. The first place to look would be an increase in the corporate tax rate, which you'll remember it used to be 35. President Trump at the time with his tax package got it pushed down to 21. And now Joe Biden would like to see that be 28, therefore paying for the infrastructure bill he'd like to get passed. The problem is it doesn't seem like there's enough support in Congress to get that done, and a compromise at 25% seems a little bit more likely, which is going to create a shortfall. So you got to go somewhere else. And this is where the capital gains tax rate increase really comes in, which is really what, as it relates to tax change, most people have been talking about recently. Right now, for most people that pay long-term capital gains tax, that's at a pretty favorable rate of 15%. If you have a higher level of income, you may pay up to 20%. And if you also have a higher level of income, you typically will have to pay what's called the Obamacare surtax, which is an additional 3.8. So those in the highest brackets right now on long-term capital gains would pay 23.8%. Well, Biden wants to make that significantly higher. He would actually increase the capital gains rate for those with incomes, taxable incomes of $1 million or more, up to 39.6, which is the old top tax marginal rate. Plus that Obamacare surtax gives you a pretty meaningful tax increase. And that's before you even get into the state tax. So with some states, depending on the state you live in and the capital gains rate in that state, you could be paying, again, if you have that income of $1 million or more, up to 50% and potentially more in some states, which is a significant increase over the current capital gains rate. So that's what he wants to do. And while admittedly, that can be a fairly popular political thing to do, because who's it going to impact? Incomes of $1 million or more, which, okay, these uber affluent people with tons of income, sure, let them pay higher taxes. That's traditionally been a more popular political avenue to tax increases. But for those that have maybe, and this was a conversation that Tim and I had the other day, and he brought up a great point, is like, imagine the person who's built a small business up over the years with a lot of blood, sweat, and tears, and has gotten to the point where it's retirement time and it's time to sell that business on, and you're able to sell it for $2, $3, $4, $5, who knows, $1 million, which, for a good, successful business isn't a ridiculous sum of money. Well, can you imagine now under the new tax code, if that law were to be passed, what a significantly massive impact that would have on that family for kind of a one-time, lifetime event. So it could be fairly troubling in certain situations. But that particular issue aside, we'll find out where that goes. We'll find out what the exact bill looks like, whether or not there's enough momentum to end up getting that passed into law. That's still pretty uncertain at this point. Another point of uncertainty is, if it is passed, when does it take effect? And if you think back to 2017, the Tax Cuts and Jobs Act that President then, at the time Trump, got passed through, that was another reconciliation bill. And that tax change passed into law in 2017, but took effect January 1st of 2018. So it was January 1st of the following year. Would that same thing happen? Well, there is some people that think that that bill could be introduced in the second or even third quarter. And if it's passed that early in the year, maybe it won't start January 1st of the following year. It's possible that it would take effect when the bill's signed into law, which is troubling, but could theoretically happen. The Omnibus Reconciliation Act of '93 that President Clinton passed, that was a significant tax change that was actually retroactive to the beginning of that year. So it's another way to say it's just really hard to know, but it does underscore a theme. When you've got the level of national debt that we have, the amount of government spending that we've seen in response to the global pandemic, and I'll go ahead and I'll share a slide here that'll put this into a little bit of perspective. But this is just a graph that plots the top marginal tax rate in this country and the lowest tax rate in this country going back a really long time. And you can see we're right here at 37% is the highest marginal tax rate. And if you put that into this historical perspective, we would say that the current tax code that we're enjoying right now is a fairly attractive tax code. It's pretty accommodating versus historical standards. So you've got this combination of an accommodating, attractive tax code with high levels of government spending and national debt, and political pressure already building, and a president's been very vocal about wanting to increase taxes. I think that the general consensus is taxes are going up, they're not going down. We don't know exactly how much, we don't know exactly how, we don't know exactly when, but if I'm a betting man, I kind of tend to fall back to the idea that taxes probably aren't going to be any more attractive than they are right now for as far out as you want to look. You never know, but that's kind of the way the things look. Remember that the Trump tax code that took effect in 2018 naturally sunsets at the end of 2025 and is replaced with the tax code that was in place before that tax package, which is still fairly accommodating. It's not quite as accommodating, but it is still, from historical perspectives, still a pretty good tax code. So we'll have to see where things go and what ends up happening with tax rates, but it is something that we're highly attuned to and always have been. Right, we've operated under this mantra that tax planning for a family is a critically important thing. I've heard Todd say any number of times over the years, and now I've just taken that from him. That's kind of my idea today. Is I just stole a bunch of stuff from everybody, but because it's good wisdom, and that is you will lose more to taxation than you'll ever lose to the worst market. And I really do believe that to be true, which is why tax planning at a family level is such a critical thing, and it can take different forms. Right? Sometimes you'll accelerate income. You'll realize income on purpose and potentially defer deductions to a future year to try to take advantage of this year, what might be a more attractive rate. Or you could look at this year and say, okay, I've got a significantly higher level of income this year than I'm expected to have next year. Let's say I did have a business sale go through, or I got a giant bonus and my income's higher this year. you could potentially push off income into a future year and accelerate deductions into this current year. And there's any number of ways to do that. We're big fans of Roth conversions and effective charitable giving strategies. There is no universal solution. The best thing that you can do at a family level is to take a look at how do things look this year? How do you expect them to look in the future? And what strategies can we execute on to try to take the best advantage of that we possibly can? The idea is not to reduce your tax bill this year, which kind of seems a little bit counterintuitive. And unfortunately, I think most accountants have been programmed that way, that they want to try to have you pay the least amount of tax this year as they possibly can. The idea, I think the better idea, is to try to reduce the lifetime tax burden that you, your family, maybe even your kids and your grandkids might end up facing, which those two things don't always go together. Sometimes that actually does result in on purpose increasing your tax bill this year because it might save you taxation in the long run. And we're happy to talk to any one of you about your own specific situation and talk about what tax planning strategies might make sense, of course, guided by your own accountants. I will add one little comment to this around not income tax, but estate tax, which is also something that's being talked about quite a bit. The most notable of those is Bernie Sanders introduced a for the 99.5% bill, but that's been one of any number of bills that we've seen be introduced this year. Don't know which of those may get passed, if any of them, but kind of like income taxes, the general consensus is estate tax is going to become more problematic, not less. And in fact, you remember I talked about the current tax code sunsetting after 2025. Well, the estate exclusion does as well. Right now, it's roughly $12 million per person in lifetime estate tax exclusion. If no new laws get passed, that drops down to $5 million starting in 2026, adjusted for inflation. But you could, without any law changes, go to sleep on December 31st of 2025 and wake up January 1st of 2026 with an estate tax problem you didn't have the prior year. So if you're a family and that might apply to you, if you're that kind of $10 million plus net worth kind of family, you really do need to be thinking about what kind of maybe even aggressive estate tax planning strategies might make sense to execute. Talk to your estate attorney about that. Talk to us about it. We can tell you to go talk to your estate attorney about that. But there are a number of strategies that you could put into place that are designed to provide a little bit of a hedge against that particular risk. What's a little bit scary is if a bill is passed, it is a little bit more common that those types of bills that impact the estate code do take effect immediately once they're ratified. Meaning that if you wait too long, if you wait until after the bill's already in place, you don't get to go back and do some planning. You have already missed that opportunity. So we would definitely encourage you to always be thinking about appropriate estate planning, appropriate estate tax strategies. And again, we're happy to talk to any of you about that anytime it may make sense. So enough of my ranting on taxes. I think we'll go ahead and move into the next question now.
Yeah, which really is broad. There's a broad-based questions that came around our political and our social environment that's currently evidencing itself. And so I wanted to kind of lump in some data points and speak into our current political environment and hopefully give a little bit of comfort where there may not be overall. And so if we just take a look, I want to back up and just show, here's what the Pew Research does this survey pretty consistently. And I pulled one from 2019. I didn't pull the most up-to-date one because this chart helps to highlight some of the long-term views of Republicans, Democrats, and how they view the economy. And as you can see, it's largely defined, their perspectives are largely defined by who's in office. President Bush becomes president, President Bush II becomes president in 2000, and what happens to Democratic perspectives on the markets? They fall significantly relative to Republicans. Obviously, we were in a recession during this period of time, but Democrats relative to Republicans. We see what happens in 2008. What happens? Well, Republicans were positive on the markets in 2007. Obviously, we had a massive financial crisis during that period of time. But what happened after we started the recovery? Well, Democrats gained relative to Republicans. And then in 2016, obviously, President Trump gets elected and Republicans immediately gap up significantly. Democrats fall. And the same is true that followed President Biden's victory, last year. And so what I want to encourage us all on is we have political leanings, whether we think it or not. We're either extremely liberal, extremely conservative, or somewhere in between. And the important thing to remember is when we back up and we look over a long period of time, markets tend to make money whether there is a Republican or a Democrat in office. Obviously, there can be policies that are implemented that affect the longer term outcome or outlook of various firms and entities. But generally speaking, companies will continue to innovate and grow because that is their response, that's their duty, right? That's what they're trying to do. They're trying to make money so they can feed their families. They're trying to grow so they can enhance their own personal outcomes. Companies tend to make money longer term, regardless of the outcome, whether it's a Democrat or a Republican. We've seen markets fall during a Republican presidency. We've seen markets fall during a Democratic presidency. We've seen markets rise during a Democratic presidency and rise during a Republican presidency. The point is, just because it's the president, our encouragement is try not to allow our political leanings to speak into our outlook for the specific markets. When we look at our current political environment, it is one of the most tightly contested, not tightly contested overall, it is one of the tightest margins between Democratic control that we've seen ever. And this is 2021 as a highlight of the Democratic majority. As we look over all the way back through 1937, or since 1901, forgive me, you can see one of the slimmest majorities in the Democratic majority that we have currently. We have 50 senators that are Democrat, 50 senators that are Republican. Obviously, the tie vote goes to Kamala Harris, our vice presidency. But when we look at the House, it's very slim margins there as well. The point is, and our hope is, that it will require some element of getting along and actually trying to work together. And this is evidenced in this chart for 2020, our Senate polarization score. So you can see the most conservative members of the Senate, Mike Lee, Rand Paul, Ted Cruz. You can see the most liberal senators on the Democratic side. Elizabeth Warren, you've got Cory Booker, Bernie Sanders. And then you've got these individuals in the middle, whether it's Lisa Murkowski, Susan Collins, Joe Manchin, Kristen Sinema. You've got various members of the Senate that are a little bit closer than they are further apart, even though they're Republican and Democrat. And the point is some of the fears for members of the Republican Party when this election happened was that some of the most extreme portions of the liberal agenda were going to be put into place. And the point in these last two charts evidence the fact that there is probably some element of negotiation that needs to take place. Joe Manchin's recently come out over the last couple of weeks and alluded to he's against the filibuster. He's against some of the things that the most liberal portions of his party are in agreement with. And so our hope by looking at some of these charts is that there's an ability to actually, we are polarized as a country, but there is some middle ground that we might be able to work on to where some of the most extreme effects may not necessarily get put into place. And so we'll see ultimately what comes to that. The point in this chart is there maybe is a little bit more common ground than we maybe think when we read or look at the nightly news. There were some questions that I briefly want to at least comment on that related to our national debt. Ryan had alluded to tax policy as a way to potentially cover some of that ground and an increase in taxes, but this is simply a chart of where we currently sit in terms of our federal net debt as a percentage of GDP. Obviously, 2020 was an interesting year, and in response to the government shutdowns, right, we forced out checks to individuals, or we signed up for payroll protection programs, and the government sustained the economy and sustained people while we shut down and hung out in our homes for a couple of months. That had obviously an effect in terms of the net debt that we have as a country. And that rose to levels that we last saw during World War II as and frankly, as FDR was launching the New Deal. obviously that projection that we have there, the CBO forecast, that is under current law. And so we're currently talking about tax policy changes potentially, and we'll see ultimately what comes of that in the coming months and days. But that is generally a projection of where we sit today. The question, though, is, so here's what we sit as a relative factor, percentage of GDP, government net debt as a percentage of GDP against other countries across the globe. We obviously aren't the worst. We're not the best overall. There is some element of a theory that is working its way through economic policy, and it's called modern monetary theory. And what that effectively says is, look, as long as we're the reserve currency of the world, we have an ability to expand debt as long as inflation is under control. That is a theory that's working its way through policymakers, whether we actually call it that or not. I would argue we're there. And the question is what comes of that. Longer term, it will be interesting to see how we manage that. We generally believe, ultimately, that debt needs to stay in control. You cannot spend ad infinitum. There either needs to be, one, a reduction in spending, or two, an increase in taxes to be able to control the longer-term debt. There obviously is a response to significant economic crisis, and the response was the government funding that, and that's become more and more common. Longer term, obviously, there is an expectation we will need to get spending under control. For the current present moment, our debt is manageable, we're controlling it, and ultimately, longer term, it remains to be seen ultimately how we manage that. Well, as we look over the course of current today and over the short term, not significantly concerned about our current levels, but that is something that will need to be managed over the long haul. With that in mind, we did leave a couple minutes remaining for some possible questions that might have arisen throughout this webinar, and wanted to leave that open-ended. If not, I'll have James close us out.
So I haven't seen any questions that have come across. We do appreciate the time that everybody spent with us. We know that you guys are all busy, and hopefully we were able to accomplish our goal of giving you some confidence in your investment strategy moving forward, giving you some good talking points and things for yourself to think about, and gave you confidence in your plan. It does look like we had one question pop up. I'll see if I can find it.
I found it. You guys look great. Who are you wearing? Whatever my wife bought me.
I think I've answered every question with I don't know and I don't know. The blue one. Thank you, though. It's always good to hear. Well,
thanks everyone. Have a great rest of your morning and a great rest of your week. Appreciate you sharing your time with us.
Thank you. Thanks everyone. See you next time.